Hey guys, welcome back. Today's video is going to be a little bit more educational. So I'm going to be talking about shares versus warrants versus units. I see these questions all the time in the comments for my videos and also on online forums where people aren't exactly sure how they work, especially the units, and which one is better. When should you choose a warrant over the shares and vice versa? So today we're going to be talking about how the SPAC units work and how they become shares plus warrants. Then after that, I'm going to be talking about the SPAC arbitrage and how you can use the warrants for leverage. Then we'll talk about how I use them, kind of my strategies, how I pick one over another, and then we'll go on with some examples. I'll pick up a few SPACs and I'll tell you what I would do with them. So let's get started right now. All right, so let's get started by talking about how units become shares and warrants. So my goal with this video isn't to make you an expert on every little detail of the SPACs. You might have more questions, but you have to understand the very basics so that when I'm talking about the strategies, you'll know what I mean and what components I'm talking about. So when a company wants to start a SPAC, they file with the SEC Form S1, which defines how many units they want to sell, at what price, and how much money they're trying to raise in the IPO from investors. So a unit is one share plus one fraction of a warrant. So usually it used to be 1/3, but nowadays it's changing. For example, PSDH, Bill Ackman's SPAC, is giving us 1/9 of a warrant with an extra 2/9 if people hold through the merger. So the share component of the unit is very easy to understand. It's just like any other share from that company. But what confuses people are the warrants. Warrants are a little bit like stock options. If you guys are familiar with calls, if you exercise your call option, you're going to be getting shares from another investor. So nothing new is created. You're just trading your money for their shares. It's a little bit different with warrants because you're redeeming your warrants for a certain price from the company itself. Usually that price is $11.50. Not all SPACs are like this, but the vast majority. So you'll be trading in your warrants and you'll be getting shares for $11.50. And that process is dilutive because then there's more shares in the market. So each share is going to be worth a little bit less. So that's why often you'll see when the warrants become redeemable, the stock price is going to drop because people know that people are going to be exercising the warrants. So what happens next is the sponsor is going to go out and try to raise money from institutions and sell those units. So all of that money gets put into a trust account, and then that money is used to acquire a target eventually once they get into an agreement. But if they can't get into an agreement, then that money gets redistributed to us investors. And that's why often I mention in my videos that $10 is kind of a floor price before the merger. Well, that's because that's the amount of money that they have per share in the trust account. So if you guys bought shares for $10.50, you can assume that there's about 50 cents that's at risk, and the $10 is sort of protected by the money that's in the trust account. As opposed to if you bought shares for $25, then you have $15 at risk and $10 that's protected. So once they account for all of that, they're going to file the Form 8K, and about 52 days after that, that's when the units can be split into shares and warrants. So now in the market, you'll have units, shares, and warrants that all trade at the same time. All right, so this is a website I use a lot to follow the new filings, spacinsider.com. So they do a really good job at compiling them. So these are the S1s and these are the 8Ks. So I loaded one up already. This is a new company called Software Acquisition Group. All right, of course it's a SPAC. So in their S1 filing, we can see that they want to sell 17.25 million units, $10 each, so a total of 172,500,000. So you can this is where you'd find how much you're trying to raise. And then in the 8K, this is Red Ball Acquisition Corp. It's kind of interesting. This is Billy Bean's SPAC. So if you went down and you read all of this, it basically tells you that they were able to sell a certain number of units and they collected a certain amount of money. Now we can see that Red Ball Acquisition Corp, RBAC unit, is actually trading now for a few days, right? So they did their filings and now they're on the stock market, but only as units, no shares or warrants yet. Eventually, like 52 days after they're filing, this is where technically they're going to be starting to split between the warrants and the shares. So now, how do you actually split those, right? Well, each brokerage is going to be different, so you guys are going to go and see what your brokerage says. But for example, on E-Trade, most of them you just have to contact your brokerage and tell them that you want to split them. So if I'm not mistaken, on E-Trade, I believe that it's $38 for the voluntary action. And if you guys complain enough, some of them are going to be waiving the fees, especially if you're doing fairly often with a lot of different stocks. Often, if you complain enough, they'll let you get it for free. So now you guys know everything about how the SPACs are started and how the units transform into shares and warrants. So now we can start talking about the actual strategies. All right, guys, now we're getting into the more advanced stuff. This is where things get really exciting. Let's talk about the arbitrage and leverage. Now, remember, there's three components that are being traded at the same time. You have the units, the shares, and the warrants. And there's a discrepancy between the prices because all three have a different risk profile. So depending on the price, there's different opportunities that you'll find in each of them. So now I can't explain all of this just with the PowerPoint, so I'll have to show you real numbers. But just remember that warrants are usually redeemable for 1150. Keep that in the back of your mind. That's going to come in really handy. All right, so we're going to use two companies to illustrate that leverage and arbitrage I was talking about. First one is going to be Hyliion, which a lot of you already know. So each unit of Hyliion is worth one share plus half of a warrant. So you're going to need 2 units to get one full warrant, meaning that the stock price of the unit has to be the sum of one share plus half of the warrant. Well, I calculated it already. Half of the warrant price plus the stock price does equal the unit price in this case, but it's not always the case, right? So it means that in this case, for this stock, all three components are in sync. Like they go up about the same. However, where it gets really interesting, which is where like the advanced strategies come in. The warrant's at 1202 right now, but we know that it costs you 1150 to redeem one share from the company. That means that if you add it, it does 23.52. Wait a minute, that's a lot lower than the current price that's at 29.91. That's about a $6 discount, right? Why is that? Well, there's two main reasons. Number one, warrants are a little bit more risky than the share price because they don't have that $10 money in the trust account that would get redistributed. So if the merger doesn't go through and the SPAC gets liquidated, you wouldn't get your money back. So that's why you have to be careful with warrants. You have to make sure that it's a company where you're very confident that the merger is going to go through. Or it's money that you don't care if you lose it, like worst case scenario. The second reason is people have the anticipation that in the future, when they do become redeemable, a lot of people are going to redeem them, and that's going to dilute the stock and make the stock price go down. And because of that, they can't pay the full 21.91 because then they would be overpaying. So this is what causes opportunities in the SPACs is you have these three different components that give you different opportunities. All right, so I mentioned that they're not always in sync. This is Hennessy Capital 4, ticker symbol HCAC. So right now, each unit consists of one share of the company and 3/4 of one redeemable warrant. So if we look at the share price 1043, the warrant price 159, so you would do 3/4 of that. Well, the sum of the two is lower than the current unit price. So buying the units right now would not be worth it. Like you would be overpaying for it. So this is a case where all three components are not in sync. So it would make no sense to buy one over the other. You'd go for the cheaper options, unless you had a very specific reason to buy units. But I'm not aware of that strategy. All right, guys, so before I get into my own strategies, I just have to talk about the leverage that you can get from the warrants, which is why a lot of the more sophisticated investors pick warrants over regular shares. The reason why is if you look at the price of 1202 for Hyliion's warrants, you can get 2.48 times more warrants for your money than you would shares. So that has to be considered because it magnifies your results. You're going to get more upside if the stock goes up than you would if you own shares. I mean, that's a fact. So for 163, the stock went up yesterday. So the warrants went up 163, which was at 15.69%. Well, the actual share price went up 307, and that was at 11.44%. So you can see that the more you have warrants, you're going to get that magnification factor, and that's where the leverage comes from. But it's not always the case. You have to be very careful. In this case, the stock went up enough where the warrants had time to overtake the share price. But that doesn't always happen. If we look at Hennessy Capital, the share price at 10.43 means that you have about that 43 cents that's at risk. It's very close to the floor price. But the warrants are at 159. So you can see that you're overpaying significantly for the warrants. And the whole thing why people are buying warrants instead of share prices, instead of the shares, is they're betting kind of like we say it's an investment, but at the same time, it's still kind of a bet that the warrants are going to eventually overtake the normal shares. Right? So you have to do a calculation in your mind. You have to decide what's good for you. And I'm going to share my strategies on how I decide what I'm going to do. All right, guys, so now it's time to talk about my strategies. How do I attack these SPACs? Well, first, just remember this is the way I do things. I'm just some dude on YouTube, right? You have to adapt it to your own strategies. I don't claim to have all the answers. This is just how I've been doing it, and I've had some moderate success, but just keep in mind you have to adapt it to your strategies. But with that said, the first thing I look at is it a stock that I want to keep long term? Do I really believe in their business model? And is it something I'm passionate about? If so, then I'm going to lean towards shares. If it's a company that I'm not as confident in, or I consider it more of a short term trade, then often I'm going to lean more towards the warrants to get that magnified result and to get that leverage. Often I'm going to be looking at a timetable of selling them before the redemption period. So a second thing I look at is how much money I want to devote to a stock. The more I like a stock, the more I'm willing to invest money into it, and that gives me more leeway to buy shares. Because let's say I want to invest $10,000 in a stock, well then that lets me buy a critical mass of a few hundred shares. As opposed to if I only wanted to have exposure for $1,000 into that stock, well then I wouldn't be able to buy like several hundred shares. I might be able to buy 50 or 100, and to me 100 is the cutoff where I'll never buy less than that because you need at least 100 shares to sell covered calls, which is part of my strategy, right? So let's say that it's a stock I don't care about as much and I'm looking to limit my exposure to it, then often I'll go for warrants because my theory is if the stock price goes up a lot, then I'll have exposure to it. But if it stays flat, then I'm not losing much. And who knows, in the future, in 2 years or 3 years, if the stock really goes up, then my warrants are still going to be in play. So then after that, I drill down, it's more of a case by case scenario. So one thing is that I look at the stock price. Let's say that it's closer to $10 to $12, then often I'm going to lean towards the shares because I like the fact that the ratio of money risked before the merger versus the potential gain is a lot higher. So yes, overall, because you're paying 10 something, your eventual profit is going to be smaller, but your risk versus reward is going to be fairly high. If we look at a stock like HCAC that's currently at 1043, well, you're risking that 43 cents. If the stock price goes up to 1150, well, then the money that you risked, 43 cents, versus the gain, $1.07, you're more than tripled, right? So you're not going to get that with a warrant. The same warrant that's currently at 150 would barely go up, if at all. In fact, it might actually go down if the price only goes to 1150 because the amount that you redeem the share for is 1150. So right now you're way overpaying for the warrant versus the share price. I hope that makes sense, right? It's that risk versus reward that I'm looking at with these stocks. Overall, the return is going to be fairly small, but when you look at the ratio between money risked versus money gained, it's very high when it comes to the shares. So another thing I'm going to take into consideration is it going to be a part of my portfolio that I sell covered calls on and collect premium? Because if you guys have been following me for a little while, you know that this is a big component of my portfolio strategy where I have to sell covered calls and do theta strategies to get premium, which I use to buy more long-term buy and hold shares, and also to pay my bills, right? If I want to live off of my investments, I need income, and the premium from covered calls is part of that. But you can't do that with warrants. Warrants, you only make money if the stock price goes up. So there are two different strategies. If it's a stock I want to hold long term, then I can generate income from selling options on it, but I can't do that from warrants. But the warrants are still a big part of my strategy, both long term and short term. I'll give you two examples. Number one is if I don't believe in a company very strongly in the short term, but I believe that over time they'll do better, right? So here's a good example, BurgerFi, OPES. A lot of you guys love this stock, but for me, I'm not that convinced. Like, we're still in the pandemic, so it's tough for restaurants, and the better burger is a theme that's fairly competitive. So short term, like, I'm not that excited about the stock. I don't want to devote thousands of dollars into it, but I still want to have some exposure to it. So what I'll do is I'll buy warrants, especially at the very low, right? When the stock's beaten down as much as possible, I'll buy some warrants with the expectation that over the next 5 years, because that's how long the warrants last, over the next 5 years, the stock's going to recover and eventually they'll do well. So let's say that the stock price ends up going to $20 in 2 years. Well, my warrants, the results are going to be magnified. Like, I have more leverage than if I had bought shares, which for like 2 years wouldn't have done much. So this is my strategy for long term. Like, if it's a stock I don't believe in as much in the short term, then I'll go for warrants and have a small exposure to it. But warrants are also very good when I expect a short-term spike in price, especially leading up to the merger or when the letter of intent is signed. If we were thinking of Hyliion earlier, right now we're in that period where the stock is going towards the merger, so it's starting to trend up significantly. And what did we see? We saw that the warrants on a percentage basis are going up faster than the share price. Well, this is when I would veer towards the warrants to get that magnified result. So let's say that you don't plan on keeping these shares after the merger and after the redemption, like all you're looking for is a short-term trade. Well, that's when I would look for warrants. So in a lot of cases, if it's a company that I want to have long-term, but I also want to exploit the short-term like boost in price, I'm going to do both. I'm going to have some shares, the part that I want to keep long-term, and then I'm going to have warrants that I just want to dump after the merger. All right, guys, so let's look at some examples, and that's going to tie in everything we've been talking about. First up, we have LCA. This is a company where I bought shares instead of warrants, and I can't believe I only got 200 so far. I need to buy more. But the reason why I went with shares over warrants is that this is a company that I want to keep long term, and I'm going to be using it as my cash cow, right? I'm going to be selling calls on it, and I'm going to be collecting that premium every week or every month, depending on how they structure it. So I couldn't do that with the warrants. So it made sense to me to buy them as shares, right? So I bought these under $12 and I still need to get more. Number two, we've got OPES. We talked about this one earlier. This is a company where I bought warrants instead of shares because I don't really believe in it that much short term, but I still wanted to have exposure to it. So I only wanted to like put around $1,000, right? Or not too much. So I bought 500 warrants, paid 140 each. So I'm up already 48% with it. So if they recover long term and do well, like if they go to 20 bucks, I'll get a pretty good return without having risked much. Now we have SHLL, Hyliion. I actually bought warrants on Friday. I paid full price, so this is not great, right? They were $6 a week or two ago, but I still have my shares that I want to keep long term. I just figured I wanted to compound it a little bit more, just buy a few more, just get a little bit more exposure to it. So I bought some warrants with the express purpose of if the stock goes up to 40 or 45, which is my price target, or if it exceeds it, I'll just sell the warrants and never look back and just keep my shares, right? So by buying warrants, I just get that extra oomph, that extra leverage that I was talking about earlier. So instead of paying $9,000 for 300 shares, look, I have 300 warrants, but it only cost me 3,600. So it didn't cost me as much to get almost the same exposure. Then this is JWS. This is an interesting case. I want to show you more of a short-term spec play. This one is already closed. I sold it already. I had bought these with the express purpose of if they signed that letter of intent, that would have made the price spike a little bit, and then I would have sold the warrants. So this was more like short-term capital gains type play. So this one I bought 600 shares, 600 warrants, sorry, paid 190 to 225. So I was into it for 1300 and I sold it 9 days later for 265. Right, so I made like $275 onto it for a risk of 1300, so about 20% profit in 9 days. So it could have been a little bit more. They went up to 320. I'll be honest with you guys, I mistimed this one. I sold it too early, but still, I mean, it's a $20, 20% gain in 9 days. It's not too bad. So this is the type of thing that you can do with warrants. You can do those short-term plays, and you'll still get a high percentage gain if it goes your way, right? If I had bought shares of this, I wouldn't have gotten nearly as much money. So it really depends. Like if you're looking for a short-term play, you can go for warrants. If you're looking for a long-term play, often I'll be going more for shares. All right, so before I wrap up, I just wanted to show you guys a live opinion on a stock that I haven't analyzed before and how I would approach it. So this is Diamond Peak Holdings Corp, which is going to be merging with Lordstown. When I did my review, you can see in the description, I mentioned that for me that was dead money, so I wasn't going to invest into it right now. But let's say that I wanted to invest into it. What would I be looking at? Well, right now the stock price is $13.34 and the warrant price is $4.10. So if you add the 1150, you can see that the redeemable value for the warrants is going to be $15.60, as opposed to the share price is $13.34. So if I was to invest in this stock right now, I would be looking at the shares personally, because eventually I would be able to sell covered calls on it and everything, and I feel like I would be getting a better value. Now, the reason why someone would go for the warrants is if they expect that the share price is going to go up significantly and overtake the warrant price. Remember, the further out we go from the floor price of $10, the more the warrants become better value. But for now, with the stock price where it is, I think that the stock price would be better value. So for me personally, I'd be going with the share. So guys, I hope this really helped you. I know that this type of topic is a little dry, right? It's not as exciting, but you have to understand the strategies to really benefit and make money in the stock market. So I hope that this video helped you. If you liked it, please comment below. If you hated it, please comment below. I love your feedback. I'm sure you'll have more questions. Just ask away. I love answering. So I'll see you guys in the next video.